Professor of Finance at UNC Tainan Regular Business School. Today, I'm going to present my new paper, The Impact of Derivatives on Cash Markets, Evidence from the Introduction of Bitcoin Futures Contract. This is a joint work with Patrick Augustin at McGill and CDI and Alexey Rubtsov at Global Risk Institute. Okay, what is this paper about? In this paper, we revisit the old and long-standing question: how does the introduction of derivatives impact spot markets? The old wisdom is without financial frictions, derivatives are redundant, and therefore there should be no effect. There shouldn't be any effects. However, in the real world, we are faced with many financial frictions. So in that case, it's not easy, right? So impact depends upon the relationship between the derivatives and spot assets. And there has been extensive debate in the literature, and this debate is very far from settled. For example, Mayhew, 1999, provides an extensive literature review on this question, and he cited so many papers, and many papers reached to very different conclusions. Some papers find no effect, and some papers find negative or positive effect. So in this paper, I exploit the introduction of Bitcoin futures by CBOE and CME in December 2017 to study this old question, because we believe cryptocurrency provides the unique setting to shed light on this long-standing question. In addition, studying the impact of regulated crypto derivatives such as the Bitcoin futures launched by CME on crypto cash market is important in light of growing unregulated crypto derivative markets, which I'm going to discuss very soon. And I'm going to start my presentation with a very simple figure that has motivated this research. As you may have heard, Bitcoin or other cryptocurrencies are traded on multiple cryptocurrency exchanges with multiple fiat currencies. For example, if you're US citizens, then you typically go to some US-based cryptocurrency exchange and make an account and trade cryptocurrency with the US dollar, the USD. However, people outside of the US, for example, people in South Korea, they actually go to their own local cryptocurrency exchanges and use Korean won to trade cryptocurrency. Well, what's interesting is there exists a significant price dispersion across exchanges. And this was documented by Markov and Shor and many other researchers. This means that although the same asset is traded, for example, Bitcoin, the price of Bitcoin in one exchange is often much larger than the price of the Bitcoin in another exchange. And this actually is suggestive of some inefficiency existing in this market. So in order to motivate the question, I draw this simple plot. And this blue line plots the average correlation of returns of Bitcoin BTC USD minus average correlation of returns of BTC CCY. Here, CCY refers to fiat currencies excluding USD. And how can I actually compute this measure? In order to compute this measure, the first part, I choose the exchanges where BTC is traded in US dollars. And I consider all possible pairwise combination. And I compute the pairwise correlation and take the average of them. And I do the same exercise for the second part, and I take the difference. So intuitively, this quantity measures the relative efficiency of BTC USD compared to the BTC. And this second vertical line is the date on which the first Bitcoin futures was introduced, which is December 10th, 2017. And before this introduction, as you can see, this correlation difference actually fluctuates around some horizontal line. And this first vertical line is date on which when CME announced that it will launch the Bitcoin futures soon. So after this announcement, we start to observe some increase in this difference. And this difference becomes more pronounced after the actual introduction of the futures. So the main takeaway from this figure is that we observed that following futures introduction, Bitcoin futures introduction, USD appears to become more efficient relative to other BTC CCY. And this simple figure has led our team to study this important question more seriously using more rigorous approach. And here's the roadmap of my presentation. First, I will explain why this event, the introduction of Bitcoin future, is so unique and useful to understand the long-standing question. And I'll emphasize the importance of this question in the current context. And this is followed by my main analysis, hypothesis, and identification strategy, and how I measure the market characteristic that I mainly use for the dependent variable. And I will explain my data, and this is followed by the main empirical findings. And I will refine my main results using some institutional details regarding the Bitcoin futures. And I will show that my results are quite robust using this robustness test. And I will conclude. Okay, first, why is this event, the introduction of Bitcoin futures, so unique and useful to understand the long-standing question? The first reason is cryptocurrency trading infrastructure is unique. In the cryptocurrency market, identical cryptocurrencies are traded on multiple cryptocurrency exchanges, as I have explained before. And these cryptocurrencies are fully fungible across trading venue. For example, investors who are trading Bitcoins in an exchange in the US, for example, the Coinbase, can send them to an exchange in another country, for example, in South Korea, and sell them there. This is possible because these cryptocurrencies are fully fungible. And these are the rare features even in closely related markets such as ADR. Another interesting feature is that this Bitcoin futures was introduced on specific Bitcoin exchange rate. CBOE and CME introduced the futures only on BTC USD, and no futures was introduced on other BTC CCY exchange rate pairs. But graphically, so this futures, CME and CBOE launched the Bitcoin futures on BTC USD. So it is likely to affect the BTC USD pairs in several cryptocurrency exchanges directly, but it may not affect the other pairs directly. So because of this unique feature, we can clearly identify the treatment group, which is BTC USD, and control group, which is BTC CCY. Not only that, due to the unique features, two unique features, we can exploit both across and within exchange variation of BTC attributes, for example, price efficiency, while keeping exchange and currency characteristic constant. What do I mean by that? We can not only compare the change of price efficiency of BTC USD in Kraken with other cryptocurrency, other pairs like BTC EUR, in Bitstamp and Gatecoin, in a more conservative specification, we only compare the price efficiency of BTC USD and price efficiency of BTC EUR in the same exchange. So that's why this offers a very unique opportunity to study the impact of introduction of futures on the on stock market. Another interesting feature is that this event is largely unanticipated, so it's plausibly exogenous. CME announced BTC USD futures on October 31st, 2017, and it actually introduced the futures on December 17, 2017. So about like 6 weeks after. And CBOE launched BTC USD futures on December 10, 2017. And this first vertical line is the announcement date of CME. And the second vertical line is the Bitcoin launch date by CBOE. As you can see, before the announcement, and by the way, these blue colors are blue lines plots the Google search volume index for the keyword Bitcoin futures. Before the announcement, although there was some search volume, we barely observed the search volume, right, compared to the later period. But after this announcement, the search volume starts to increase, and it hits the peak on this actual implementation, launch date of the Bitcoin futures, right? If this event was anticipated before, then we should observe some large search volume in the pre-period, but we don't observe it. So that's why I argue that this is the largely unanticipated event. Overall, all these unique features allow us to identify the impact of introduction of features in a diff and diff setup. Okay, then why is this question so important? The first reason is there are active regulatory debates about the benefits and detrimental effects of crypto derivatives and other crypto products like Bitcoin ETF. There are opposing views by regulators. For example, former CFTC chairman Giancarlo says, regulators allow the launch of BTC futures because it would pop the Bitcoin bubble and make prices better reflect the fundamental value. So he has some positive view. But some people like Yellen calls Bitcoin inefficient, so she has some negative view. And while the CBOE officially filed with SEC to list the shares of Bannex Bitcoin ETF, SEC has consistently denied the proposal for Bitcoin ETFs. And the decision is going to be made next month. While the US regulator was hesitating, Canada's financial regulator approved its first Bitcoin ETF in February 2021. The reason why some regulators have different make different decision is probably because there is no clear consensus about whether the introduction of these crypto derivatives and crypto products are beneficial or detrimental for the market, right? And another important thing is we observe the rapid growth of cryptocurrency derivatives market. There are two types of derivative markets. One is regulated market, the other is unregulated market. We first observe the growth in regulated cryptocurrency derivative markets. Still, many financial institutions are not allowed to hold Bitcoin physically. So in order to have exposure to Bitcoin, the financial institution can take some position in the Bitcoin futures market. Open interest for Bitcoin futures on CME exchange increased by more than 100% from February 2020 to February 2021. So in 1 year, we observed a dramatic increase in open interest. So we observed the significant growth in the existing market, but not only that, new types of derivatives are constantly introduced. For example, options on Bitcoin futures were introduced in January 2020, and 3 months ago, Bitcoin futures was introduced. And this month, micro Bitcoin futures were introduced. And we are observing the new derivatives or new cryptocurrency related products now. And another interesting derivative market is unregulated cryptocurrency derivative markets. Many cryptocurrency exchanges, there are hundreds of cryptocurrency exchanges out there, by the way. Many cryptocurrency exchanges started to offer various types of derivatives contracts in their own exchanges. But why am I saying this is unregulated? It's because cryptocurrency exchanges are not regulated in general. There's no clear regulation on cryptocurrency exchanges. So therefore, the regulators cannot regulate the cryptocurrency derivative traded in these cryptocurrency markets. And the size of the unregulated cryptocurrency derivative market has increased significantly. For example, if you take a look at this figure, the trading volume of cryptocurrency derivative in 2019 Q4 was about $1 trillion. Yeah, this is quite big, but it increases even more in 1 year. So after 1 year, the size of the trading volume hit the $5.3 trillion, and this is even bigger than the spot trading volume of cryptocurrency, which is $5 trillion. And the major player in this market is Binance, Huobi Futures, and OKX. And these are some reputable and well-known players in this well-known exchanges in the cryptocurrency market. Crypto derivative landscape.
So let me interrupt you for a second. So there are a couple questions in the chat. So from Mike Chernoff, So why do we need ETFs on Bitcoin? Usually ETFs are based on portfolios of some sort. And then from Isan Owner, there are various papers arguing that price discovery happens at the unregulated Bitcoin futures markets. Why should one expect CME futures to have an impact on the Bitcoin cash market?
Okay, I think that one of the reasons why we need the ETF on Bitcoin is because but there are various reasons. Having ETF on Bitcoin probably will give better access to the Bitcoin market to many people, including some financial institutions, because currently financial institutions cannot physically hold the Bitcoin. So that is one of the reasons. And for the second question, there are various.
So the question is, if price discovery happens on the unregulated Bitcoin futures markets, why should one expect the CME futures to impact the Bitcoin cash market?
Yes, I think first of all, I think this unregulated unregulated cryptocurrency markets, cryptocurrency derivative market actually pick up relatively later than the regulated cryptocurrency market, cryptocurrency derivative market. So I think it's very much possible that this CME or CBOE futures have an impact on Bitcoin cash market. I think that's my answer to this question, but Patrick, do you want to add more?
In terms of the unregulated exchanges, well, so I mean,
Yes.
I think the only thing I can say is that many of these unregulated exchanges effectively kind of developed much kind of later than the introduction of the one on the CME. I mean, they existed, but there was not much activity. And also, I think, again, from an institutional perspective, institutional investors are primarily kind of restricted to invest into these unregulated kind of venues. So in that sense, again, so if you expect kind of institutional capital to come in, once you have the introduction of the actual futures contract that institutional investors have kind of access to, well, again, then it goes back to the old question of whether that actually improves the efficiency of the underlying or not, in particular, because given that they could be either substitute or complements, right? So that's kind of what I would add.
Yeah. Okay, then shall I continue? Okay.
Please continue.
Yeah, okay. The cryptocurrency derivative landscape. About 2 to 3 years ago, when I first started this cryptocurrency research, I didn't know much about this cryptocurrency derivative, especially this unregulated cryptocurrency derivatives, because the trading volume was very small, although they existed. So at that time, most people actually traded their cryptocurrency in spot exchanges, where only spot or cryptocurrency can be traded in the spot market. So they are called spot exchanges. But as time goes by, and as you have seen in the previous slides, this unregulated cryptocurrency derivative market has been growing. Therefore, new type of cryptocurrency exchanges emerged, that is derivative exchanges, where only derivative contracts were offered. But currently, we observe some other type of cryptocurrency exchanges where both spots and derivatives can be traded. And these kind of exchanges become more and more common. And that's what we observe in the current cryptocurrency market. Okay, in this research, I measured several market characteristics of Bitcoin spot markets. For example, Bitcoin USD, Bitcoin EUR, and so on, using past 3 months daily data at the end of each month. And these market characteristics are categorized into 5 categories: synchronicity, volatility, efficiency, quality, and liquidity. Synchronicity measures the cool movement of the 2 time series of the Bitcoin prices in 2 different exchanges. So we use Pearson correlation measure to measure this cool movement. And volatility, I don't even have to explain this because we all know it. What about price efficiency? We are not an expert. We are not experts in market microstructure. And therefore we just follow the literature to measure this quality. And to measure this price efficiency, we use the approach by Ho and Moskowitz. And we compute the D1 measure. And if this D1 measure is smaller, that means this is more price efficient. What about market quality? We use Hasbrook 1993 a market quality measure, Q measure. If this measure is high, that means the market quality is higher. What about liquidity? There are a bunch of liquidity metrics out there. Lowe's measure, Amihud, and CHL, and low trading volume. None of them are perfect. Therefore, we aggregate them by following the approach by Schwartz 2017. In order to identify the impact of Bitcoin futures introduction on Bitcoin USD versus Bitcoin CCY, I regressed the market characteristic on this interaction between treatment and post. This treatment dummy is equal to 1 if the market characteristic was constructed based on the BTC USD data, and 0 otherwise. And this post dummy is equal to 1 if this market characteristic was constructed after the introduction of future, and 0 otherwise. And in a conservative specification, we also add fiat currency fixed effect, and exchange or exchange pair fixed effect, and also the time fixed effect. And why am I saying exchange or exchange pair fixed effect? Because although these 4 different measures can be computed by 1 time series, but this synchronicity measure needs 2 time series. So from two exchanges. Therefore, we need exchange pair fixed effect for this synchronicity measure. In the most saturated specification, we exploit within exchange variation using exchange time months fixed effect. What do I mean by that? So we only compare Bitcoin, the market characteristic of Bitcoin USD and market characteristic of Bitcoin CCY in the same exchange in this most saturated specification. And as you will see soon, if we use this very saturated, most saturated specification, our results stay strong. Let me briefly explain my data. We merged 2 most reputable and well-known databases in the cryptocurrency market, Kaiko and CryptoCompare. And these databases have been used in many other academic papers on the cryptocurrency market. And our sample period starts from July 1st, 2016, and it ends on December 31st, 2018. And our database consists of 22 exchanges where Bitcoins were traded in our sample period. And in this 22 exchanges, we identified 10 unique Bitcoin fiat currency exchange rate pairs. Of course, this BTC USD should be there, and this is our treatment group. And our control group consists of 9 different exchange rate pairs: BTC USD, BTC GBP, and so on. And eventually, we end up finding 46 unique Bitcoin fiat currency exchange pairs. And this is our first main empirical finding. In this regression, we regress the Pearson correlation on treatment dummy, post dummy, and treatment times post dummy. Of course, in this specification, this is the most important coefficient. But at a first glance, you can think that the signs of the coefficients for treatment and post dummy are somewhat counterintuitive, because one can think that, oh, maybe the Bitcoin USD is more efficient than Bitcoin others in general, but what we found is the opposite. And this post-dummy is negative, which means that rather than the efficiency on average increases as time goes by, it shows that actually it decreases. So we were also quite curious about this and found that this result is mainly driven by some exchanges that are subject to the trading volume manipulation. In the cryptocurrency market, because the cryptocurrency markets are not very well regulated, some cryptocurrency exchanges actually exaggerate their trading volume or generate some fake trading volume in order to attract the investors. So in column 9, we actually exclude those exchanges that are subject to the trading volume manipulation. And if we do that, we don't observe this negative and statistically significant coefficient for treatment and post dummy at all. So we can say that although this looks a bit counterintuitive, they are driven by some exchanges that are exposed to or prone to the trading volume manipulation. And let's just focus on this interaction term from now on. The first, the coefficient, and the first column is 0.121. And this is statistically significant at the 1% significance level. And this number is quite economically significant as well, given that the standard deviation of this y variable, the price synchronicity measure, is 0.18. And we make the specification more conservative by adding a fixed effect, exchange rate, exchange pair fixed effect, and time fixed effect, and currency, fiat currency fixed effect. And as we include them one by one, although we observe some decrease in the magnitude of the coefficient, actually it doesn't change that much. Why don't we actually add all separately? Then even if the coefficient decreased slightly, but as you can see, the difference is not very big. And in our most conservative specification, column 6, we interact this exchange pair dummy with the time dummy. As I said before, we only compare the row, the Pearson correlation of BTC USD and correlation of BTC others in the same exchange in this specification. Not surprisingly, the magnitude is smaller, but it is still statistically significant. And if you remember this standard deviation, it is also economically significant. In the next columns, we perform some subsample analysis. In the first 6 columns, we use all these 9 pairs as control group. But in 7, we only chose BTC EUR as a control group. In column 8, we exclude EUR from these 9 pairs. And as you can see, the effect is stronger in the specification 7, which means the Bitcoin USD improves like relatively more compared to EUR than the other control groups. Column 9 is about like deleting or excluding the exchanges that are prone to trading volume manipulation. One thing to note is the number of samples drops significantly. Therefore, in some specification later, in some specification for other dependent variable, we sometimes lose statistical significance, but it doesn't mean that there is no effect because we significantly lose the sample size. But in this specification, we not only observe that the coefficient is positive, but it is statistically and economically significant. Overall, this result shows that after the introduction of Bitcoin futures, Bitcoin USD becomes more efficient relative to Bitcoin others. And I will explain this result with some graph. So here I estimate this regression model, and I estimate this alpha, which is the coefficient for the interaction between treatment and the time dummy. And as you can see, before the introduction, yeah, of course, this alpha fluctuates, but it fluctuates around 0. And it is not significantly different from 0. And after the introduction, we observed some increase, although it wasn't big. But as time goes by, this magnitude becomes bigger, although we observe some drop here, but it is recovered later, right? So on average, we observe that the alpha is pretty high right after the introduction of the futures, and we don't observe the pre-trend, okay? So I have 4 other measures, and I will just give you the basic or big picture of this because we have so many numbers. So I will examine volatility, market quality, price efficiency, and liquidity. And as you can see, the interaction term is negative in all specification, right? Although in some specification, when we lose a lot of sample, we lose the statistical significance. But if you look at the coefficient, their order of magnitude are quite similar. And I would focus on this 5 and 6 because 5 is quite conservative and 6 is very, very conservative, even more conservative, right? But even in this conservative specification, we observe minus 0.039 and minus 0.06. And this is economically significant given that the standard deviation of volatility is 0.22. So after the introduction of Bitcoin futures, the Bitcoin USD's volatility decreases more relative to others. And what about market quality? As I said before, if market quality variable is, this measure is high, that means it has high quality. And in all specification, they are positive, and in most specification, they are statistically significant. For example, if you take a look at column 5, it is 0.36. It's almost 50% of this standard deviation of Q. And this effect stays strong even in the most conservative specification. What about price efficiency? We observed a similar pattern. The lower D1 means the higher efficiency, and we observe all negative numbers, and they are statistically and economically significant. What about liquidity factor? As I said before, we can come up with several liquidity measures, and here we aggregate them by following Schwartz 2017. And as you can see, in all specification, they are negative, and the order of magnitudes are quite similar, right? About minus 0.3. And they are in many cases statistically significant. And this is even bigger than the 50% of the standard deviation of lambda. So this effect, this effect is quite strong, remains strong even in the most conservative specification. In the previous 6 slides, I highlight the positive aspect of the introduction of Bitcoin futures on the cash market. It improves it decreases the arbitrage opportunity, and it increases market efficiency, market quality, price efficiency, liquidity, and it actually decreases the volatility of tokens, right? And I'm going to refine this result using some institutional details regarding the Bitcoin futures. The CME Bitcoin futures are cash settled using CME CF Bitcoin reference rate. This is called BRR, determined at 4 p.m. London time. And this reference rate is determined by the prices of Bitcoin in 4 different exchanges. These are relatively well-known and reputable exchanges: Itbit, Kraken, Bitstamp, and GDEX. What about CBOE? CBOE Bitcoin futures are cash settled using USD auction price for Bitcoin determined at 4 p.m. Eastern time. And this reference rate is determined by the transaction in Gemini. Previously, what I did is this. In order to measure the return, I first observe the price at the end of the day, the midnight price. And then using that midnight price, I compute the daily log return of the BTC UR and BTC USD and BTC CCY. But here I take some different approach. Rather than observing the price in the midnight, I'm going to observe the price, record the price at 4 p.m. London time for these exchanges and 4 p.m. Eastern time for Gemini. And I'm going to do the same exercise on this small number of exchanges. We had 22 exchanges in total, but now we have 5. But unfortunately, we don't have the data for GDEX, so we have 4 exchanges. So let's do the same exercise using end of day price and settlement price. And this column 1 to 3 corresponds to the column 1, 5, and 6 in the baseline results. No fixed effects and conservative specification and the most conservative specification. And as you can see, if we regress this market quality Q on this interaction between treatment and post, these coefficients are negative and is close to 0 and is not statistically significant, although it was positive and very statistically significant in the baseline result, right? So if we use the end of day price, the effect is quite small. But if we use settlement price, now we observe that the coefficient becomes much larger, which is comparable to the coefficient that we have seen before. And in some specification, it is statistically significant. But as I said before, because we only focused on 4 exchanges, the number of observations dropped significantly. It was about 920 in the baseline result, but we only have about 20 observations. So even though we sometimes don't have the statistical significance, that doesn't mean that effect isn't there, but we just have too low power. So in column 4 and 5, we find that the coefficients are big and statistically significant, although it's not statistically significant in 6. But at least we observe that the coefficient increases dramatically. What about liquidity? even when we use the end of day prices, this liquidity effect is strong. However, if we use the settlement price, this effect becomes even stronger. So the overall finding is the effect is stronger with returns measured at settlement time. This suggests that Bitcoin price is likely more informative at the settlement time due to the introduction of the Bitcoin futures. Okay, then why do we observe this positive effect? And we were trying to examine the channel, and we first thought maybe it's related to attention. If investors pay little attention to the cryptocurrency market, then even if there exists some arbitrage opportunity, the arbitrage probably does not disappear very quickly. And also it could be related to liquidity. Even if there exists an arbitrage opportunity, due to the low liquidity, maybe it is very hard to do the arbitrage transaction because it could be costly. So we measure the liquidity and attention. First, we measure the attention of the exchange by using their Google search volume in the pre-period. And if their Google search volume is above the median, then we say that this high attention dummy is equal to 1 and 0 otherwise. And we similarly define this high liquidity dummy. So we use the liquidity factor lambda. If the liquidity is above the median, then this is 1 and 0 otherwise. And as you can see, by the way, I did the proper diff and diff, triple diff and diff here, and I just don't show the all coefficient, but I just show the coefficient for the triple diff interaction term. And as you can see in all specification, the effect is very small. And I would say that there is no effect. So we didn't find any evidence that is supportive of attention channel. What about liquidity? Yeah, we initially expected that it could be positive, but we find some different result. It's negative. This means that the improvement of this co-movement is more pronounced for the exchanges that have lower liquidity. And we thought about this and we speculate that these exchanges where liquidity was high already in the pre-period had higher price synchronicity before the introduction of futures. So there's no room for this exchange to experience the better better co-movement compared to the exchanges that had lower, relatively lower liquidity. And we observed the qualitatively similar results for price efficiency, market quality, and liquidity. And this is very interesting and important slides. One can say that, the result on the most conservative specification is somewhat puzzling, because if there is any arbitrage opportunity between, for example, BTC USD and BTC UR, we may be able to do some triangular arbitrage using this fiat foreign exchange rate. So if this is possible, if this triangular arbitrage is possible, then we probably shouldn't observe the big difference or statistical or economically significant coefficient for the most conservative specification. And we were also somewhat puzzled and curious about this, and we found that actually there exists some trade institutional friction here. Markov and Shore and Dieber find that customers from different countries can only trade cryptocurrencies on their own local exchange in their own local currency. What does that mean? If you're a US citizen and if you trade in the US-based cryptocurrency exchanges, although those US-based cryptocurrency exchanges also offer like BTC EUR or BTC GBP and so on, as a US citizen, you can only use the US dollars to trade cryptocurrency. So therefore, you cannot actually use or take advantage of this triangular arbitrage. On top of that, this fiat foreign exchange rate is not tradable in cryptocurrency exchanges. That makes the triangular arbitrage even more difficult. Of course, I'm not saying that it is completely impossible. For example, suppose you have dual citizenship, then you can make an account as a US citizen, and you can also make an account as a European citizen. Then probably you can actually do this kind of arbitrage transaction. But for most of people, this arbitrage transaction is very challenging within the exchange. And that is very consistent with the effect that we find in the most conservative specification in the baseline results. And in this exercise, rather than using BTC-CCY as a control group, I use ETH-USD as a control group. And as you can see in the conservative specification, which corresponds to column 5 in the baseline result, we find some interesting results. So BTC-USD experienced more co-movement after the introduction of future compared to ETH-USD. However, if we use most conservative specification that interacts where the exchange pair fixed effect and once fixed effect are interacted, then there is no effect. Now, how can we explain this? And this could be consistent with the explanation about this triangular arbitrage. Although arbitrage between BTC-USD and BTC-EUR within an exchange was very hard because of this institutional friction, maybe arbitrage between BTC-USD and ETH-USD is much easier because in all exchanges in my sample, there exists BTC-ETH pair. And this is quite liquid pair traded in most of the exchanges. Yeah, BTC, as all of us know, this is the most famous and liquid cryptocurrency in the world, and ETH is the second biggest and second most liquid cryptocurrency in the world. So in almost all exchanges, BTC-ETH pair trading pair is available. So this triangular arbitrage could be much easier in this case, which is consistent with this no effect. One last thing that I want to emphasize is maybe one can say that the results in the result we observed in the baseline regression can be explained by USD effect. You can come up with some story that maybe there was some shock to the USD and the timing is coincide with the timing of the introduction of the future. Then maybe the all interesting finding that we find in the baseline result can be explained by the USD effect rather than the introduction of Bitcoin futures. But if that is the case, when I compare ETH-USD and ETH-CCY, we also need to find some positive effect, but we don't find it.
Can I jump in? There are a couple of questions about the arbitrages. So first from Christian, aren't all Bitcoin arbitrages challenging to execute in the first place, given the time it takes to process transactions?
Yes.
And then another related question from Amani Moyne. I don't know how to pronounce the name. I'm sorry. But anyway, can't anyone functionally trade Bitcoin USD due to the accessibility of Ether, even if you are not American?
Yeah, I think they are all great questions. And let me first answer to Christian's question. So what Christians are talking about is the arbitrage across exchanges. Suppose there is a price discrepancy of Bitcoin in different exchanges. Then what Christian said is correct. But what we are talking about here is triangular arbitrage within an exchange. So that's a different thing. And to Amani Moin's questions, yeah, she or he's right that in some exchanges we can use Tether USDT to trade Bitcoin. However, what we found in our sample is there were only one or two exchanges where USDT were traded. So even if we take out those exchanges, our results are still preserved. So I think this is not a very big problem in our analysis. Okay. Yeah, and it is true that even if you're not American, you can trade with USDT, the Tether. Okay, if possible, can I actually move on? I'm almost.
Please go ahead.
So yeah, as you can see, we tried our best to do the robustness test, and there are so many bullet points here, and in the interest of time, I'm not going to explain all of them. But let me explain these last two bullet points. We conducted the placebo test using hypothetical dates of introduction of Bitcoin futures. So currently the introduction of Bitcoin futures was in December 2017, right? but we proposed, we actually used two hypothetical dates for the introduction of Bitcoin futures, and not surprisingly, we didn't find any effect. And another interesting thing is the introduction of Ethereum futures. Many people talked about this before, because Ethereum futures was launched by CME as well 3 months ago. So people asked me whether we will observe the similar results. And unfortunately, we don't have enough data after the introduction of futures, only three months period. And I believe we need at least 6 months or 9 months data to do the proper analysis. But even though we don't have enough data, I tried my best to run some baseline regression, and find that price synchronicity for ETH/USD increased faster than that of price. And I have actually some slides for it. So if anyone asks about it after the presentation, then I'll explain that. And let me quickly conclude. Okay, cryptocurrency provide unique opportunities to shed new light on the long-standing question, and that question is: do derivatives increase the efficiency of spot markets? And we use the various market characteristics like price synchronicity, volatility, market quality, efficiency, and liquidity. And our clear answer to that question is, if the derivatives are offered by the regulated exchange in the cryptocurrency market, the answer to this question is yes, they do. Okay, that's all I prepared. So if you had more questions, then I'll be happy to answer.
So at this stage, anyone who wants to ask a question is welcome to, unmute yourself and use your microphone and shout out your question. So,
yeah, Donghwa, I'll just a quick clarifying question with respect to your answer to my previous question. So you're saying that when we are on these markets and we stay on the same market, there's no need to go through the blockchain, essentially.
Yes, so here, triangular arbitrage, here I mean the arbitrage within an exchange.
Yes,
so
but
in that case, we don't have to go through blockchain. But
okay.
What you have said is like the price of Bitcoin in Korea is much higher than the price of Bitcoin in the US. In that case, we have to go through the blockchain. So, and that's, I think, what you are mentioning. And that there exists a lot of friction, actually, because as you said, there is some uncertainty for the transaction. It is possible that your transaction is not executed and it takes long and so on, right? So yeah, that is a little different from the triangular arbitrage that I mentioned here.
Okay, so it clarifies one of the worries I had, but so still the measure of correlation you're using to talk about synchronicity, this one is fundamentally affected by the difficult cross-exchange arbitrage, right?
Yes, yes.
So kind of the maybe a cheap question is, how can we generalize what we see in this market? Essentially, I was looking at the stats you have for your row measure in the paper, and on some days you have kind of a 50% correlation between returns on a pair on a market and the same pair on another market, right? This seems like an extremely low correlation for return on the same asset.
Right.
So the conclusion that derivatives do improve the cash markets, is it a conclusion that works only when frictions are extreme? That's kind of the
Yes. Yeah, I think to answer to your question, maybe I can use this specification one more time. So what you said is, yeah, I was also surprised. In some exchanges, if there are some exchanges where the correlation is extremely low, yeah, it's not even 0.5. So that actually made me worried whether my results are driven by that. So in many specific, in various specifications, I try my best to mitigate the concern. And this column 9 actually partly mitigate your concern. So this here, I exclude many exchanges that are suspect to, that are subject to trading volume manipulation. And the only exchanges that are left in these specifications are all reputable exchanges. And in those exchanges, we observe relatively high correlation in general. That's probably the reason why we find the smaller effect, because in the baseline result, for which we use all sample, including some suspicious exchanges, the effect is stronger or bigger. But even after we actually exclude them and generate much smaller and conservative sample, we find the effect. So your intuition is correct. Yeah, when we include those exchanges, the effect is stronger, but it's not entirely driven by that.
Thank you.
So let me ask a question. Let's just for the moment assume that Bitcoin is a big bubble.
Bitcoin is bubble, yeah.
Bitcoin's a bubble. I mean, it's hard to say. It's not clear what the fundamental value of Bitcoin should be, but let's suppose it's a big bubble. If we measured the bubble, it would be a little bit different on different exchanges because the prices are different on different exchanges. So are your results consistent with the hypothesis that the introduction of the futures contract just made the bubble the same on different exchanges? Right? Just made everyone agree about the price?
Yeah, I'm agnostic about that because of course I don't know what is the fundamental price and which component is bubble. What we only can say is they could move more. But as you can say, as you've just said, it could be just bubbles and pure bubble, but that bubble actually could move more after the introduction of futures. But not only it actually, Patrick, can you add more if you want to add more?
Well, I think it's like Neil said, right? It's a speculative question about whether there is a bubble or not in the first place, right? So what is the fair value of Bitcoin? I think no one knows, right? But I agree. So the only thing that we can say to that question is whether kind of the introduction of the futures makes prices more aligned or makes kind of the trading in these markets more liquid. And again, always in a relative sense, relative to the trading venue, or essentially, or the asset where we do not have the derivative. But let's say
this kind of test, looking at the effect of introduction of a futures market or a derivatives market of some kind, has been done over and over and over again for all kinds of markets over the years, and almost always done this way as an event study. And I've always wondered about that and been a bit skeptical in many cases that the introduction of the market is the big event. If you introduce a market but nobody trades it, which is true of like thousands of existing futures contracts, it's hard to see how that should have a big effect on the underlying cash market. Now, it could have a big effect if the existence of the futures market is a sort of an information aggregation mechanism. A lot of agricultural commodities, for example, it's unclear kind of where is the cash market in things that are produced all over the country. But the futures market is a single market that unifies that and provides information, even if nobody trades, the fact that there is this central market. One can make the same argument about treasury bond futures, where again, a T-bond cash market is a little bit dispersed, but there's one futures market and everybody can look at that. And even if there isn't a whole lot of trading, maybe the information coming out of this one market would have an effect. But when you think about things where it's going to depend upon arbitrage for the future to affect the underlying cash, then it really has got to matter what the trading volume is. So I'm astonished and very impressed at the strength of the results you found here with just the introduction. And maybe it's that the CME is big and the Bitcoin cash market is small. Maybe that's what's going on, but I really like to see results looking at trading volume and open interest in addition to just the introduction.
So maybe there's, I mean, I think the comment is well taken, Steve, but I would like to give a little bit of pushback, right? Because I think what you're referring to is the channels, essentially. Kind of why is this happening? And as you correctly pointed out, is it just the information effect that comes through the kind of the announcement of it? And is it more kind of because of now the availability of another kind of a complementary asset that you can either kind of choose in addition to the underlying as a hedging instrument or as an alternative, right? We could see kind of effects in both directions. So then, of course, it goes, what is the ultimate effect? Is it an informational effect or is it a liquidity effect? And that's what we did when we looked at kind of essentially additional kind of heterogeneity across exchanges in terms of information or in terms of liquidity. And so the results there point towards kind of a liquidity effect, right? And so, but I think once you have the introduction, that's when you have the availability of the two assets, so you can have a trade-off. Now, the second thing I think is, I agree with you, kind of most of these studies have been done using event studies, and either kind of it's kind of, I think in the CDS market, we have event studies where we have heterogeneity across the timing of the CDS introduction and so forth, right, for bonds and so forth. And the results are typically mixed. I think what the neat thing here is that, again, I think Donghwa mentioned is the full fungibility of the assets across exchanges. And then we can literally kind of keep the technology, kind of the time variation in the technology of a particular exchange constant, or we control for that, and look at the within exchange variation or the exchange pair when we look at synchronicity. And I think that's kind of what makes this particular kind of experiment here unique in the sense of looking at these results.
Mm-hmm.
Did volume jump immediately upon the introduction of the futures?
Question.
I mean, volume went up. Good question. Of it jumped immediately. That's, I don't recall. So we'd have to look at. Donghwa, do you?
No. We need to check.
One thing I'd be interested in is the difference between the, what should I say, the safety of trading on an unregulated exchange. I'm concerned a little bit about the safety of trading Bitcoins in the first place. When there have been these examples of Bitcoins that have disappeared and no way to do anything about that. They're stolen, there's no way to find out who stole them, or they somehow disappear out of the exchange without anybody knowing where they went. The CME is well regulated and we can have a lot of confidence in them, but I don't know about these exchanges, derivatives exchanges that are run by the Bitcoin exchanges themselves.
Yes, that's actually, so yeah, that is quite interesting area to research, and we actually look forward to work on this unregulated derivative research. Maybe although we studied the regulated exchanges and probably shed some light on the unregulated exchange as well, but we also admit that there could be some big difference between these two different types of exchanges, especially the types of derivative products they are offering are quite different. For example, Bitcoin, so CME or CBOE actually offer quite standard Bitcoin futures contract, although in some unregulated market, the types of derivative are much riskier. So there could be some difference. So yeah, Patrick and I have some plan to study the unregulated Bitcoin cryptocurrency derivative market as well, unregulated cryptocurrency derivative market as well.
But it's just, I mean, I think you're absolutely right, Steve, right? So I think that's a concern that this could be driven by some kind of fishy exchanges, especially that are more prone to attacks or kind of that are more likely to be crooked than not. So I think part of the way that we address this is by having the exchange pair or the exchange fixed effects, right? So you're just kind of like controlling for the unobserved characteristics that do not vary over time. The other way that we kind of look at this is by filtering out those exchanges that have been flagged as manipulative, right? So there are a number of proposals for ETFs that have kind of said, well, which exchanges do we trust more and which ones do we trust less? This is more in relation to trading volume manipulation. So like the wash trading rather than like price efficiency. But still, like typically when we exclude authorities exchanges, also things kind of go through quite strongly. So, but that's a fair point. Yeah.
Mm-hmm. Yeah, very interesting paper.
Just to add to Steve's and Donghwa's comments, the CME futures is actually quite, the contract size is large, and the margin you have to put up to trade on that is substantial. And in other exchanges, either in cash or in other futures exchanges like perpetual futures, you can actually get exposure to Bitcoin at a much cheaper price. So I think there's different kind of clientele which is attracted to unregulated futures markets versus regulated futures markets as a result.
Yeah, I agree. Yeah, I fully agree. Yeah. So we can easily like generalize our result to on the unregulated cryptocurrency exchange, cryptocurrency derivative market for sure.
Can I ask a question? Who provides liquidity for Bitcoin futures on the CME? And let's suppose the liquidity provider is long the futures. How do they hedge it? How do they hedge their long position?
By taking the position in those markets.
So can you short Bitcoin?
In Bitcoin futures market, yes.
No. Let's suppose you're a liquidity provider who's long the futures. And how does he hedge his long futures position?
So
I mean, basically, it was just going short. Like you can sell the Bitcoin dollar, you can buy the Bitcoin dollar, right? So,
okay.
So you can basically have a long position in the futures contract. You can just basically sell the dollar in the underlying, right? Have a synthetic position, right?
Okay. Other questions? Last opportunity to ask a question. Last opportunity to tell Donghwa he's wrong. I'm sure no one wants to do that. No more questions?
Then I will jump in and thank Donghwa very much for this presentation, for his devotion to VDW, presenting in the middle of Korean night. Thank you very much, Donghwa. And see you everyone next week for Andrei Ermolov's presentation on the variance risk premium in equilibrium models.
Christian, do we get the copy of the chat to respond to the individual questions as well?
Yeah, someone will send you a copy of the chat eventually.
Thank you very much.
And we'll let you know when your video is available on YouTube so you can be a YouTube star. All right. So thanks very much. With that, I will close the Zoom.
Hey, ciao everyone.
Thank you very much.
Bye. Thanks.